Toronto landlords are stuck. Some Toronto landlords saw this coming. Others hoped the numbers would eventually start to make sense again. You've got landlords sitting on negative cash flow condos. They can't sell, they can't refinance, and in a lot of cases can't break even at today's rental rates. And if you own an investment property in Toronto right now, or you're thinking of buying one, this video is your wake-up call. In this video, I'm going to break down why so many Toronto landlords are stuck, how rising costs and stagnant rents have created the cash flow trap, and most importantly, the 3 strategies you can use to protect your investment and actually come out ahead. Stick around till the end because the solution might not be what you think. What we're seeing in the Toronto rental market isn't a short-term pain. It's a structural reset. And unless you adjust your strategy soon, you could find yourself holding an investment that bleeds cash for many years to come. Let's start with the mindset I hear from some investors across Toronto right now. It's fine. I'll just hold it. Rental will go up. And on the surface, that sounds reasonable. After all, supply has always been tight in Toronto, right? Not anymore. With record condo completions the past 2 years, institutional investors building up the supply of purpose-built rentals, and lower immigration numbers, this is a long-term shift which puts a lid on future rent increases. Here's the problem. The math has changed. Mortgage rates have increased since 2020 and 2021. Condo fees have jumped significantly due to inflation. Toronto property taxes went up 23% the last 3 years, and rents have stalled. For example, you have investors collecting $2,300 a month on a 1-bedroom condo, but paying over $3,500 in mortgage payment, condo fees, property taxes, and insurance. That is over $1,200 loss every single month, and that's before any repairs or emergencies. Between 2020 and 2022, investors were buying up pre-construction condos at record prices, gambling on appreciation. Fast forward to 2025, those same units are completing now. We've had record completions last year and this year, increasing the supply of rentals, not to mention the additional supply of purpose-built rentals. There are structural issues with the pre-construction condo market which need to be addressed moving into the future. Here are 3 challenges that I see. 1. The timeline between signing the purchase agreement and taking possession is way too long. Currently, it takes anywhere from 4 to 6 years to get a project complete. That's too long for a buyer to wait. In 4 to 6 years, the buyer can get married, have kids, or get a job relocation. Their life can be completely different by the time they get possession. Waiting for that long doesn't make sense for someone who wants to move into the unit. Second point, financing a new development is tricky as banks require 70% of the units to be sold prior to providing construction financing. In order for developers to sell 70%, the units are shrunk to keep the prices attractive. These smaller units pretty much attract only investors, as very few end users want to buy a shoebox to move into 4 to 6 years from the date they sign the purchase agreement. 3. Taxes. Today, approximately a third of the new construction condo or home price is taxes, levies, and development charges by the various levels of government. This adds significant cost to the final purchase price, making these homes unaffordable to end users and forcing developers to shrink the floor plans to make the price point more attractive. I don't see how the pre-construction market will rebound to provide housing supply and especially supply of homes where families can live in if the above 3 factors are not addressed. Back to today's market conditions. Many investors are realizing the numbers don't work buying pre-construction condos anymore. Some are trying to assign their contracts only to discover buyers aren't willing to pay what they did back then. Some sellers are walking away from their deposits and hundreds of thousands in losses. Others are closing and trying to rent out if they can get a mortgage due to lower appraisal values, only to find their carrying costs exceed their rental income by over $1,000 a month. These are standard downtown condos, the same ones that were marketed as cash flow positive just a few years ago. This isn't bad luck. It's about a market that's restructuring. The fundamentals of real estate investing are back. Buy for cash flow and do not bank on speculative appreciation, which only worked in the era of cheap money. So how do you move forward? Some investors say, no problem, I'll just rent it out and wait for prices to rebound. But that's where many walk straight into the landlord trap. Because once you rent out your property in Ontario, your flexibility drops. Selling a tenanted property is challenging and reduces the pool of potential buyers, which would result in a lower sale price. Even if you issue the N12, after having a firm sale agreement, the tenant can refuse to move out, causing delays and financial hardship. With the landlord and tenant board backlog, even if you do have a legitimate reason to end a tenancy, it could take months to get a hearing. Meanwhile, monthly carrying costs keep adding up, not to mention the stress. You've got maintenance fees that don't care about your rent cap, special assessments for older building repairs, and skyrocketing condo fees on newly completed condos as a reserve fund need to be fully funded. Insurance premiums are up the last few years due to floods and fires, and a property tax system that seems to be hungry for more money every year. You're left holding an asset that's draining cash on a monthly basis without an easy exit strategy. If you think selling is the easy way out, here's today's reality. Today's condo buyers aren't the same ones from 2021. They're cautious, analytical, and have a lot of choice. They're comparing dozens of listings, and they know exactly what's overpriced. The unit needs to be 10 out of 10. It has to show perfect. It has to be staged very well and priced aggressively according to where the market is. In 2021, fear of missing out drove the market. In 2025 and beyond, fear of overpaying is the decision maker. Even if you're ready to list, you've got to be strategic, because pricing based on what your neighbors sold a year or 2 years ago will go nowhere. Let's talk about what waiting actually costs. Say you've got a $700,000 condo, you're losing $1,200 a month in negative cash flow. That's just over $14,000 a year, or $28,000 in 2 years gone just to hold that asset. Now, imagine you wait 2 years hoping the prices climb by 4%. Even if you gain $28,000 in appreciation, your holding and selling costs will wipe that out. And that doesn't include the stress of not knowing what you will get when selling in the future, dealing with tenants, and opportunity cost of what that money could be doing in another type of investment. So how do you move forward? Well, there's no one-size-fits-all answer. This market rewards strategic repositioning and not stubborn holding. Here are 3 options to consider. Some landlords will pivot into multi-unit investment properties such as duplexes and triplexes where cash flow is achievable. Others will sell underperforming condos to free up equity for other opportunities such as RRSPs, RESPs for their kids, stock market, or a business investment. And third, few will restructure their financing to extend the amortization or bring in partners to manage the upcoming period. But they all have in common is taking action, since doing nothing is not a good option. If you think being a landlord in Toronto is just about collecting rent and waiting for appreciation, those days are long gone. We are back to real estate investing 101. Buy for cash flow in areas with potential for appreciation. The beauty of a positive cash flow business or investment is you get to choose when to sell on your own terms. You're not pressured or forced to make a difficult decision. The old saying of cash is king has never been more true than nowadays. The smartest financial decision isn't to wait, it's to make a move before you get trapped. If you found this video helpful, give it a like and subscribe. If you want to book a call with me to discuss your current situation, there's a link right down below in the description. Thanks for watching, and I'll see you on the next one.